The aim of the High Net Worth Individuals and Sustainable Investment Study by Eurosif is to look at the motivation behind the high net worth individuals' interest in sustainable investing and to better understand how they integrate environmental, social, and corporate governance criteria in the way that they actually do their investment decision making. This study was created with the support of Bank Sarasin and Highland Steward Management, and we'd like to thank them for their support of our efforts. Eurosif approached approximately 420 organizations for the survey, expanding beyond the initial group surveyed in 2008. The market itself has grown quite a bit since the 2008 survey. Eurosif estimates the 2010 market to be approximately 729 billion euros. That's roughly 11% of all money owned by family offices in this sector. So 11% is in sustainable investing. And those numbers are projected to grow to roughly 15% in the next 2 years. A key finding from the study is that sustainable investment is now largely perceived by the European high net worth population as a financial discipline rather than an investment style, where specific knowledge of ESG, that is environmental, social, and corporate governance issues, is necessary in order to be successful. Interestingly, the study finds that the financial crisis had an overall positive effect on the high net worth individual market and their interest in sustainable investing.
It had at the end of the day a positive impact on our business in the sense that we got many more clients, also in the sense that it was maybe the final trigger to change the offering for private clients by default into a sustainable investment offering.
High net worth investors tend to move from a satellite to a core approach over time in the adoption of sustainable investment in their portfolios. Eurosif calls this trend the toe dipper trend, meaning that investors start off as toe dippers with only marginal sustainable investments as a part of their portfolio, but they over time migrate into shallow water swimmers. These shallow water swimmers now approach roughly 60% of the surveyed respondents, meaning that between 1 to up to 20% of their portfolios qualify as sustainable investments. Our research indicates that the inclination towards sustainable investment from inherited wealth stems from a wider sense of responsibility towards society, while the entrepreneurial wealth band seeks sustainable investments as a means to foster and develop the green economy. Both groups share a belief that this form of investment does not sacrifice financial returns. Moreover, the survey points out that sustainable investment is clearly no longer seen as an alternative to philanthropy at all, with less than 10% of high net worth individuals stating that they are filling a philanthropic need when investing sustainably. The onus is now on retaining existing clients who are asking for more variety and depth in sustainable investment options from their wealth managers.
I mean, at the end of the day, performance is still a very critical element and obviously a very, very important one. Client service is also a key element. That means report in an appropriate way towards the client. Then thirdly, I would argue we have to make sure that the offerings we have does allow a client to invest the whole money in a sustainable way.
78% of the family offices say that sustainable investment will increase with the generational transfer in the family office. Eurosif hopes that this study will further contribute to a better understanding of the trends in sustainable investment from high net worth individuals and help to make sense of a market that will undoubtedly contribute to shape our financial future.